Welcome. In this explainer, we're going to break down a really fascinating options strategy. It's one that lets you profit from big market swings, no matter which way they swing. I know, that almost sounds too good to be true, but trust me, it's very real. Okay, so let's just dive right in with a classic problem for every single trader. You have to pick a direction, right? You buy a stock, you're betting it's going up. You short a stock, you're betting it's going down. But what if you are absolutely sure a huge move is coming, but you have no idea which way? And this brings us to what we can call the directional dilemma. It's that fundamental challenge in investing, the one where you have to correctly guess where the market is headed next. I mean, think about it. With normal stocks, it's a binary choice. You're either long, hoping for a pop, or you're short, hoping for a drop. If you're wrong, you lose. And if you just sit on the sidelines, well, you can't profit at all. It feels pretty restrictive, doesn't it? But what if there was another way? A way to bet not on direction, but just on volatility, on the size of the move itself. Well, this line of thinking leads to an incredibly powerful strategy that totally changes the game. And that strategy is the long straddle. It is an absolute game changer for traders who think a major price move is on the horizon, maybe because of an earnings report or some big news, but they're just not sure of the direction. This is a strategy designed to profit from pure, raw volatility. So how do you build one of these? Well, it's actually pretty simple. You do two things at the exact same time. You buy a call option and you buy a put option. Now, here's the key. They have to have the exact same strike price and the exact same expiration date. You're basically covering both bases. So the most important thing to remember is that you're creating a position that can win whether the stock skyrockets or totally tanks. You're essentially buying a ticket to profit from a big event without having to guess the outcome. Okay, the theory is great and all, but seeing the numbers is what really makes it click. So let's walk through a clear example to see exactly how this works in the real world. So imagine a stock is trading at exactly $50. We're going to buy a call option and a put option, and both will have a strike price of $50. Now, in our example, each option costs $2 a share, which comes out to $200 total, since option contracts usually control 100 shares. Okay, so that means your total upfront cost is $400. That's the $200 for the call plus the $200 for the put. And this number is so important because it's the absolute most you can lose on this trade. Your risk is perfectly defined right from the very start. So where do we start making money? Well, on the upside, the stock has to rally enough to cover our entry fee, right? That means it needs to close above $54 at expiration. Where do we get that number? It's the $50 strike price plus the $4 total premium we paid. Any price above 54 is pure profit. And the same exact logic applies on the downside. We need the stock to fall below $46 to turn a profit. That's our $50 strike minus that same $4 premium. If it closes anywhere below 46, our put option starts printing money. And this shows your goal perfectly. That area between $46 and $54, that's your loss zone. If the stock price just stays flat and ends up in that range when the options expire, you lose money. Your mission is to see the stock make a big enough move to break out of that middle range and launch into one of the profit zones. And let me tell you, the profit potential can be huge. In this scenario, let's say the stock rockets up to $60. Your call option is now worth $1,000. After you subtract your initial $400 cost, you're left with a net profit of $600. That's a 150% gain on your investment, all because you bet on a big move happening. So this all sounds pretty great, but when do you actually pull this tool out of your toolbox? I mean, this is not an everyday strategy. It's a specialized instrument for very specific moments. This strategy is just perfect for situations where a big catalyst is on the horizon. The classic example is right before a company's earnings report. Another one is when a stock has been trading sideways for a long time and just looks like it's coiling up for a massive breakout. And ideally, you'd use this when the cost of options, what we call implied volatility, is pretty low, making your entry ticket cheaper. These are the prime opportunities you're looking for. Of course, no strategy is a free lunch. There are absolutely no guarantees in trading. So let's get real for a minute and weigh the risks and rewards of the long straddle. So on one hand, you have unlimited profit potential without needing a crystal ball to predict the direction. That's incredibly powerful. But on the other hand, it is a costly strategy because you're buying two options, not just one, and the biggest risk is that nothing happens. If the stock just stays flat, both of your options will slowly decay and expire worthless, and you'll lose that initial premium you paid. This quote really captures the double-edged sword of this strategy perfectly. It's a powerful tool for profiting from uncertainty, but it's a bet that something significant will happen. Which leaves us with the final question you have to ask yourself before ever using it. Are you just hoping for volatility, or do you have a genuine, solid reason to expect it?